the negative part of my argument is going to be trying to show that there isn't any good theoretical case to establish that the government needs to or should provide money or regulate banks. The leading market failure arguments don't really hold water. In order not to be misinterpreted, let me sort of repeat something I learned from one of my economics professors. Whenever he was asked, "So, Professor, you have faith in the free market?" he would say, "No, I don't have faith in the free market. I have evidence. I have evidence that free market institutions work." So that's the kind of case I'm going to try to present. All right, so I've talked a little about Hume's theory and Adam Smith's theory. You can go back to the very origins of money. Karl Menger's theory. Karl Menger was an Austrian economist, the late 19th century. If you want to understand why money emerges in the first place out of a barter economy, Menger explained how each individual in a barter system has the problem. If you're trying to swap what you come to market with, say you're an asparagus farmer, and you want to go home with plaid shirts, you have a problem. You got to find somebody selling plaid shirts who wants to be paid in asparagus. Right? And if he doesn't want asparagus, now you have a problem. So what can you do? Well, you can go home and wear your asparagus, I suppose. Or if you're a little bit entrepreneurial, say to yourself, or say to the guy selling the plaid shirts, "Well, if you don't want asparagus, what do you want?" He says, "I'm looking for cabbage." "Oh, well, in that case, if I can trade my asparagus for cabbage, I could trade the cabbage for the shirts. And if you can do that, then cabbage becomes your medium of exchange. It becomes the vehicle which carries your exchange process forward." So once people discover that, they become on the lookout for trades they can make that, even if they don't get them what they really want to consume, get them a step closer. And whether it gets you a step closer depends on whether other people will accept it. So you need to be on the lookout for what other people want to consume or will use as a medium of exchange. And that sets the stage for the whole thing to converge. Because if I see that a lot of other people are using salt as a medium of exchange, then I'll use it because now I can trade with them. So the group of people who accept it grows, and the economy converges on a commonly accepted medium of exchange. So no king had to invent money. No, Chamber of Commerce had to get together and hold a convention and decide what it was to adopt as money. We know historically it was gold and silver that emerged out of this process. One of the things that held them back initially was gold and silver are actually not very uniform when they come out of the mine. So it took the invention of coinage as a way to certify weight and fineness so people could trust the pieces of metal that were being offered to them, as long as they could trust the seal that was stamped on it. And if you think about it that way, if you think about the function of the mint being to certify the weight and fineness of the metal, well, we rely today on all kinds of private certification agencies for weight and fineness of precious metals. You buy a gold bar nowadays, it's typically stamped by the Engelhard Minerals Company. Similarly, there was a private market that provided the service of certifying the weight and fineness of metals. In the U.S., during the California gold rush, there were something like, there were gold and silver rushes throughout the West. There were something like 20 private companies that minted their own coins. Go online, you can find pictures of them. They're quite pretty. They're quite valuable these days, so if you find one in your grandmother's attic, don't send it to that company that offers to buy your gold without telling you at what price they're going to buy it. Take it to a coin collector. And these mints, these private mints, had an excellent reputation for, in fact, we have examples of their work that have been tested very carefully. They were more precisely minted than the coins being minted by the U.S. government. They did not have a problem of fraud. Right? You might think, well, a private mint would pretend that this is a 1-ounce gold coin, but it would only be half an ounce of gold and the other half would be some copper or tin or something they snuck in there. But if you're running one of these mints, your whole business is certification. if people suspect, or if the word gets out that one of your coins was bogus, there goes your entire business. Nobody's going to bring you money if other people won't accept it because your brand name is no longer trusted. So these mints actually had an excellent reputation for certifying the weight and fineness of the gold. They didn't invent their own units. They minted them to the common official standard. There was one exception. There was a mint associated with the Mormon Church, which minted its coins 10% underweight, so that members of the church could have a built-in tithe. But nobody except Mormons would accept those coins except at a 10% discount. So that system regulated itself too. Why have governments typically gotten into the business of minting coins? Well, it's like asking why governments do anything. There are two possibilities. One is that there's some kind of market failure that they're remedying. The other is there's revenue in it. In the case of coinage, as far as all the evidence indicates, it wasn't to improve the quality of coins. Privately minted coins were quite good. On the other hand, the history of government coinage of gold and silver is a long history of debasements, mixing in more and more copper and tin and cheaper metals into the coins. Typically reusing the old coin dies so that it wasn't obvious that the coin's value had been diluted. Passing off the debased coins as just as good as the old coins. And when the public began to catch on, the government could pass a law that said, no, you have to accept the new coins as though they're just as valuable as the old coins. In medieval France, it was actually a crime to weigh coins or to test them for purity. In the French Revolution, the penalty for asking whether somebody intended to pay with government money or with pure money was the guillotine. So they made it mandatory to take their money at face value. So you can make a big profit if you can do that. Now, of course, remember we're talking about ancient despotic governments here. We're not talking about elected governments, which of course would never expand the quantity of money to raise revenue at the public's expense. Well, nowadays, for the revenue raising point of view, we're in the perfect position. We've eliminated the gold and silver entirely, so the government doesn't have to call in the coins and remint them. It just needs to print more paper in order to expand the money supply. For those of you who've taken money in banking, I mean open market operations. And so it's very easy to generate revenue. Now, in the U.S., we collect taxes in so many ways that we don't rely heavily on printing money to pay the government's bills. Although, as the government debt gets bigger and bigger, the temptation to inflate it away gets higher and higher. Right? So keep that in mind. In countries that have less ability to collect income taxes, say because so much of the economy is informal, reliance on this inflation tax is heavier. So inflation rates are typically higher in countries at lower levels of economic development. Now, most money and banking textbooks will tell you that fiat money is more efficient. It's better for the public than commodity money. And why would they say that? Because it saves resources. Right? It's cheaper to print a $10 bill than it is to mint a $10 coin. But I think they're overestimating the resource costs of a commodity standard. And I think they're engaging in wishful thinking about the management of a paper standard because they typically fail to take into account that with inflation, the inflation that's typical with a paper money standard, it's actually more costly for the public to hold money because it's melting away in their pockets. The purchasing power is melting away. That's a tax on holding money that you didn't experience under the gold standard. Some economists have unfortunately fed this misperception that a commodity standard is really expensive by insisting that a free market in money means that all money would be pure silver and gold coins or warehouse receipts for gold and silver coins. But I don't think it means that. I think it means that privately issued money is restricted by contracts. But a possible contract, and a contract that historically seemed to be attractive to people, was a fractional reserve contract, meaning instead of the bank acting as a pure warehouse, the customer gives it permission to lend some of the money out. Now, why would they be so foolish? Because that way they don't have to pay storage fees, and instead the bank pays them for using their money. They're on notice that they're taking a risk, right? But if the risk is small enough, then it's worth it to get the higher return. So banks have an incentive, and customers have an incentive to allow the banks to economize on gold as long as they live up to their promise to provide coins to redeem the notes whenever demanded. Banks provided much less costly methods of payment than lugging around bags of coins. So before banks got into payment, when payment was purely in gold and silver coins, if Alice wants to pay Bob $1,000, and suppose she's keeping her coins with a local vault keeper, she has to go to the vault, take out the 1,000 in coins, put it in her wheelbarrow, wheel it over to Bob's house. Bob says, "Thank you very much." He counts the coins, maybe weighs them, puts them back in his wheelbarrow, wheels them back across town, puts them back in the vault. Bob and Alice don't have to be too clever to say, "Hey, wait a minute. Instead of doing all this lugging of coins around, why don't we meet at the vault?" Then Alice can take the coins out, hand them over to Bob, and Bob can put them right back in. Hey, wait a minute. We don't even have to take the coins out. And this is the breakthrough that gets bankers into the payment business. You don't have to take the coins out because at the end of the day, the coins are going to be back in the vault. And all that's changed at the end of the day is the banker owes Alice $1,000 less than he used to, and the banker owes Bob $1,000 more than he used to. So Alice and Bob just have to meet in the banker's office and tell him, "Hey, move $1,000 on your books from Alice's account to Bob's account." That accomplishes the same thing as taking the coins out and putting them back in. So that's a deposit transfer. And the subsequent history of banking is the development of new methods for deposit transfer. And these new methods change the way in which the banker is notified that Alice and Bob want to make this transfer, but it doesn't really change the back end of the transaction. It doesn't change what happens on the bank's balance sheet. So Alice could write Bob a check. Alice could, well, initially Alice went to the bank in person. Alice could instead write a check, give it to Bob, and Bob could take it to the bank. Or Alice could go to the bank and tell the banker to transfer the money to Bob's account, and Bob will know he's been paid when it shows up. That's what electronic funds transfer does. Right? So when you pay at the pump, and the gas is going into your car, glug, 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 the money's coming out of your bank account, glug, 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 going into the gas company's bank account, glug, glug, glug. Not really. They wait till the end of the transaction and just do it once. But wire transfer, electronic funds transfer works that way. It's just a different way to signal the banker to make the payment. And so that's the sort of nature of technical advances in banking. Now there was a second kind of important bank liabilities besides deposits and deposit transfer, which I've already mentioned, which is bank-issued currency, banknotes.